Imagine two friends. Both are 30 years old, and both have just been handed exactly $500,000. The first friend makes a choice that sounds like the ultimate financial win. He takes the entire sum and buys a beautiful, fully paid-off home. No mortgage, no interest, no debt. The second friend takes a route that looks much more boring on paper. He puts his entire $500,000 into a simple, low-cost index fund. Then they both disappear for 30 years. No trading, no side hustles, and no changes to their strategy. They just let those assets sit. When they reconnect 3 decades later, who ends up wealthier? Our culture says it's the homeowner. We're told from a young age that real estate is the only real way to build wealth because rent is just throwing money away. This feeling comes from tangibility bias. Humans instinctively trust physical objects they can touch, like a kitchen or a backyard, over the invisible numbers flickering on a brokerage screen. But choosing emotional satisfaction over mathematical reality often blinds us to how exponential wealth is actually created. To see the gap, we have to look at the historical numbers. Long-term, U.S. housing prices grow at about 3 to 5% annually. Broad stock market index funds have historically returned closer to 9%. That 4% difference sounds small at first. In the early years, the two paths look almost identical, which is why most people don't realize how much they're leaving on the table. By the 10-year mark, the house is worth about $740,000, but the index fund has already climbed to $1.18 million. This is where compounding takes over. It doesn't move in a straight line. It grows like a snowball, picking up mass with every rotation. After 20 years, the divergence is massive. The home reaches $1.1 million, but the index fund approaches $2.8 million. By year 30, the gap is staggering. The house is worth $1.6 million. The index fund exceeds $6 million. The house grew at a predictable, steady pace, but the index fund entered a period of explosive acceleration that the physical asset simply couldn't match. When you prioritize the low volatility of a house, you aren't just buying safety. You are sacrificing millions of dollars in wealth-generating power. It's actually worse than those numbers suggest. That 4% growth for the house is a gross return. It doesn't account for the cost of holding the asset. Real estate has unrecoverable carrying costs. You have property taxes, insurance, roof replacements, and emergency plumbing calls that never stop. We tend to ignore these because of a psychological trap called mental accounting. We celebrate the fact that the house increased in value, but we separate that gain from the hundreds of thousands of dollars spent just to keep the building standing over 3 decades. Compare that to an index fund. It has no leaking roofs or surprise tax assessments. It quietly compounds in the background without demanding constant infusions of new capital. When you treat a house purely as a financial investment, you're expecting a machine that constantly breaks down to compete with a frictionless wealth engine. Now, there is a catch. If you invest everything in the market, you still have to pay rent to live somewhere. This is why we have to distinguish between utility and growth. Housing provides a place to sleep. Equity markets provide financial expansion. They serve 2 different purposes in your life. To make better decisions, you have to separate lifestyle assets from productive assets. A lifestyle asset is a consumption item. A house, like a par, improves your daily comfort, but it locks up your capital in a structure that doesn't produce anything. A productive asset is an economic engine. It generates future cash flows by owning businesses that are constantly working to produce more value. When you own an index fund, you own thousands of companies that are innovating and selling products while you sleep. Your home isn't doing that. It's just providing shelter. Conflating our need for a home with our goal of building wealth is what causes most people to misallocate their most valuable capital. Buying the house is the right move if your primary goals are family stability, permanence, and control over your environment. Peace of mind is a valid reason to spend money, but you have to accept that you're making a lifestyle choice, not an optimal financial play. If your priority is maximizing your net worth, the math is clear. Renting for shelter while funneling your capital into productive assets is the superior strategy for growth. The difference really comes down to a shift in how you look at every dollar you earn. Most people look at $50,000 and ask, what can my money buy? They focus on what they can physically possess right now. Wealth creators look at that same money and ask, what can my money build? They focus on the production that happens when money is put to work. Financial clarity begins when you stop evaluating assets based on how they feel to the touch and start evaluating them by their capacity to produce your future.